Good morning. I'm Kaushal Chari, Dean of UWM's Lubar College of Business. I'm so delighted to welcome you to today's Business Ethics webinar. The Lubar College is very proud to offer this webinar series to the public, sharing the expertise of top academics and executives and our own outstanding faculty. This webinar is sponsored by the Lubar College's M&I Center for Business Ethics. The M&I Center for Business Ethics supports an educational framework that engages Lubar students in serious thought about issues of ethics and ethical ideals that they can apply as business leaders and professionals. And through public programs like today's webinar, the center seeks to promote business ethics as critical to the success of the market-driven economy. I'm now happy to turn the program over to Dr. Maria Goranova, the director of the M&I Center and professor of Organizations and Strategic Management at the Lubar College of Business. Dr. Goranova is an expert in shareholder empowerment and activism, and will be the moderator of today's webinar. Maria, over to you.
Thank you so much, Dean Chari. Thank you for the kind words and for supporting these events. Also, thanks everybody for coming today. Special thanks to Chris Pivak. She's our assistant dean for communications, and our marketing manager, Jocelyn Sheed, for putting together this event. And of course, special thanks to our featured guest today, Marc Desjardins. I will introduce the speaker in just a second, but let me tell you a couple of words about the format. So we will have first the presentation about 35-40 minutes, and after that we will have about 25 minutes for questions. We did receive a lot of interesting questions during the registration process, and we ask you to please ask your questions in the Q&A Zoom feature. Pending time, I will do my best to aggregate the questions or try to ask them in an order such that we could address the bulk or the gist of the questions at the end of the session. Shareholder activism is certainly a topic that is very pertinent to us locally in Milwaukee, with a prominent local company targeted by shareholder activists 3 times in 13 months. But that's certainly not a phenomenon exclusive to Wisconsin. Scholars have said that shareholder activism is now a global phenomenon, and it is the new norm in corporate governance. So I try to aggregate data on hedge fund activist campaigns. Activism Insights, the last 2-year data, was in terms of number of demands, so not strictly comparable, and number of demands according to them have gone slightly down from 1,600 to 1,500, but activist demands cover a wide range of different things that shareholders are looking for, from nominating shareholders on the board of directors or shareholder nominated directors to stock buybacks or returning money back to shareholders, corporate divestitures and capital structure, approving, pushing for, or opposing merger and acquisitions, and a bunch of governance and operational issues. And I have to mention here that hedge fund activists are just a small fraction of the hedge fund industry, which itself has been rising. So if despite the slowing demands, I don't think that we could really relax in the management field. Hedge fund activism is just one type of shareholder activism. We also see a lot of shareholder resolutions that companies have to include in their proxy statements, and a huge increase, almost 40% of environmental shareholder resolutions this season, and including a lot higher proportion of them than historically are now getting majority shareholder approval. So very dynamic field, and I'm sure Mark would probably mention something about shareholder engagement. in this era, especially with large index funds like BlackRock, State Street, Vanguard, publishing their stewardship expectations and what they expect from their portfolio companies. Mark has done very impressive and very thoughtful research on shareholder activism, including studying short-term and long-term implications of shareholder activism. He received his PhD from Ivy Business School and subsequently worked at HEC Paris and Penn State. He's currently associate professor at Dartmouth University. And before joining academia, he also has done work as strategy consultant and investor relations analyst. As I mentioned, he's done a lot of impressive research, and I'm certainly not the only one that thinks so. I would need several more slides to fit all of his research awards. So I managed to only fit the ones from the last 2 years. And in recognition of his high quality publications, he's also sitting on top academic board of editorial boards, top academic journals editorial boards. His work has been widely covered in the business press by Bloomberg, Forbes, Financial Times, New York Times, Reuters, and others. For the business folks in the audience, I would greatly recommend his recent Harvard Business Review articles, Managing Shareholders in the Age of Stakeholder Capitalism. And Mark also served as the program chair of the stakeholder interest groups at Strategic Management Society. Without further ado, Mark, the floor is all yours. And thank you so much for coming today and sharing with us your insights on shareholder activism.
Well, thanks so much, Maria. Thanks for having me, and thanks to the center for sponsoring me. Thanks, Dean Chari and Chris for organizing this. And thank you to all of you for being here. I know this is webinar style, so there's not so much, back and forth in between. I may try and keep an eye on Q&A, but that may come at the end. I see a lot of names I recognize just on the list right now. So anyways, thanks for being here. I'm really excited to talk about shareholder activism. I'm going to start to share my screen and get right into it. So, okay, you can see that. So the title of today's talk is Shareholder Activism Beyond Short-Term and Long-Term Implications. It's what I'm going to do is give you sort of a portfolio approach of research on shareholder activism, my own and others, to cover this topic. I know there's some practitioners in the audience, there's some academics, there's some students, people all over the place. So I'll try not to disappoint, but I'm looking forward to the Q&A after. Maria did introduce me, but just a bit of background so you know where I'm coming from as I talk about shareholder activism and why I do what I do. I worked, as Maria said, in investor relations before coming into academia. My job there was essentially, I was working for the world's largest fertilizer company. My job was to handle incoming questions about our company, especially about the stock price, and coming from investors, coming from activists. What were the risks? Everything stock related. It was sort of a daily role of keeping on top of what the market was saying about the company, to watch our stock price and to be on any trends and any warning signs coming up. And then what I did is I entered academia and did a PhD in strategy and sustainability, where all of a sudden it was about building long-term, sustainable, resilient companies. And where what I was trying to do there is like, well, how do we do this? And this is where stakeholders and business and environment come in, because as soon as you start thinking long-term, well, you have to take care of stakeholders. You need employees, you need communities, you need the environment to operate. And so these two worlds of mine collided to sort of put me at this intersection that you see here of strategy, sustainability, and finance, because it was very much short-term stock prices and what investors care about, some investors, and then long-term business sustainability. And there was this huge tension I was seeing between, short-term and long-term, corporate short-termism. And really what I'm interested in, where I'm coming at shareholder activism from, is really from a financial world sense, and what investors and markets and sell-side analysts and all that goes on, activists, how they shape the companies that we know, that we see around us, specifically around their strategy and their sustainability dimensions. So anyways, that's a bit of background as we get into shareholder activism. So what's the plan for today? like I said, based on many interviews I've done, I've been fortunate to do, I don't know, close to 100 interviews now, I think, over the past several years. Some of the world's biggest hedge fund managers, some of the world's biggest shareholder activists, and also the CEOs, directors on the company side that have been targeted by these activists. I'm going to draw on insights there. I'm going to draw on my research portfolio. So this isn't a specific paper that I'm going to dig into. So a little different from typical seminar. And then I'm going to draw on other papers to basically give you an overview of the mechanics of activism, the activism system, the drivers of activism, the outcomes of activism. And then at the end, I want to wrap up with some trends and thoughts about what we might see going forward and some, I think, research opportunities in this space. So with that, as Maria said, activism is real, it's live, it's around us. These are just some headlines I pulled from like the past week or two. The Coles one was earlier this year, but big campaigns are unfolding all the time. And why this matters is it shapes the companies around us. Maria gave a brief overview of some of the hedge fund stats, but the number of demands there, but the number of campaigns, this is the last year alone, 173 campaigns. So she showed the number of demands, which a typical campaign, and I'll get into some of this, can include multiple demands, but 173 separate campaigns, which was slightly down coming out of pandemic. Roughly $40 billion in capital deployed, meaning stock acquisitions, these activists taking positions in these companies. Roughly 90 board seats. The U.S. activity, it's continuing to go down as U.S. style hedge fund activism is transported to other parts of the world. So Europe had a record-setting year, roughly 50 new campaigns. And then some of these are really big, high-profile campaigns that we'll talk about. We'll dig into some of these. Like Exxon, which was, tiny little engine number one, activist hedge fund, took 3 board seats with 0.02% stock ownership. Just incredible. Like, how did that happen? Toshiba, a big breakup after persistent activism. We'll talk about that when activists keep coming back. And then Box prevailing in a proxy fight against Starboard, one of the most formidable hedge fund activists. So these are big campaigns. They really matter. This is why I think we need to understand this topic as scholars, because it's not just something that happens out in the universe, out there, but these campaigns go on, and for a long time they shape the companies, their priorities, around stakeholders, around the environment, around finances, and that affects all of our lives. And this is only a growing trend. So when we, as Maria showed, as we look across the past decade or so, we're seeing more activism around the world. Okay. So with that, what are we talking about? Just a quick definition of shareholder activism is it represents a range of activities. So these bold points, we'll talk about them. So many different sort of tactics or activities, we can break those down by one or more of a publicly traded corporation shareholders that are intended to result in some change in the corporation. So intended, not always, sometimes there's adverse consequences. We'll get into that. But sort of 3 points that I want to break down from this is that the activists fall on a broad spectrum. So some are more confrontational, some are less. They vary in their class. So I mean their shareholder class, we'll talk about that, and their characteristics, their priorities, and that the outcomes vary. So I think it's super important as a baseline, as we just get into this topic, to know, and I will try and withhold from making any broad sweeping statements. I know some of you on the call right now, you study like more socially oriented activism or more shareholder resolutions, more private engagements. There's a ton of variance and heterogeneity when we talk about shareholder activism. I mean, you have NGOs taking stakes and you have like profit-minded short-term hedge funds, some of them taking stakes, and these can lead to very diverse outcomes. So with that, I just want to get into some of the mechanics of who are activist shareholders, as I was just saying, and how do they enact change. In practice, as well as in research, there's sort of 3 buckets sometimes that we can quickly think of when we think about shareholder activism. Hedge fund activism, which I sometimes think about as ownership activism, taking a decent sized stake. In many cases, a hedge fund, so they can have influence, legitimacy, and sway over company decisions. And then there's sort of this whole private dialogue space, a lot of qualitative scholars looking into this, just hard to analyze from a big data perspective across. It's hard to get these data, but great case studies about when shareholders engage sort of behind the scenes in their activism. So that fits under this lens. I put, there's debate, I think, where divestment fits. I think the research shows that divestment basically has the biggest influence when there's noise around it or like a campaign around it, so people become aware of why shares are being divested. So I think about that more as a dialogue approach, but maybe not, obviously not private. But there's that type of activism. And then there's, big literature on shareholder resolutions, on proposals, and what other shareholders are doing with their votes, so more of an engagement. These are three broad buckets. I personally, when I came into this space, I was coming with a practitioner background as well, find this kind of confusing, right? Because you have hedge funds, which is a type of investor, then you have like an activist tactic, which may be a shareholder resolution, and there's all this mixing and overlapping as we talk about these three broad buckets. So how do we break it down as scholars to sort of understand what these campaigns do and what the outcomes are? And in a recent paper with my doctoral student, Muhan Zhang, who is actually, he's at Penn State, and with Wei Shi, we just published this journal management review where we try and do exactly this. We try and understand, I'll get more into this paper later as well, but how different shareholders by engaging companies have impacts on stakeholders. And when we looked at that literature, what we saw is like, well, there's a ton of variance, right? The outcomes, all the campaigns, they differ. And so what we did, and a useful way, I think, to think about activist shareholders is to first think about their class. So are they institutional investors? And if they are, okay, are they hedge funds, mutual funds, private equity, pension funds, others? Or are they state owners, family owners, corporate investors, individual retail? We'll talk about that, nonprofits. These are very different types of or classes of shareholders. And then you have different characteristics. So you have, they have different ownership stakes. They have common ownership or not. Their investment horizons or their share turnover, their investment experience, their geographic location, their ownership structure, and so forth. And just to give you an idea like why that matters, well, if we call it just shareholder activism, treat it all as a monolith, right? A hedge fund is going to have very different effects than maybe a retail investor that's doing this. And then even if you look within one of these classes, say retail, well, a retail investor with 20% ownership versus a retail investor with a fraction of a percent of ownership, well, that's going to lead to a very different outcome. And so we think about class and we think about characteristics, and then that leads us to different tactics, different priorities, different outcomes. So as I go through this talk, what I'm going to try and do is sort of dig into some of that heterogeneity to break this down. When do activists have the effects they do, and how can we tie this back to their orientation? And so Maria's paper was really helpful here, and as we set up this review, because it was sort of like the last major big review of shareholder activism in management, like that highly cited paper setting forth, financially oriented activism from socially oriented activism. So financially oriented, like activists care about stock prices. Socially oriented activists care about environmental social issues. And so what we're seeing today is more a blending of these two, where activists use sort of a social or environmental bend to achieve a financial objective. But we can think about that sort of dichotomy. And I'm more on, some of the research I'm going to talk about today is more on the financially oriented side and the effects that has on the social side. But in this journal management paper, I was just referencing, what we did is when we looked at that literature, we saw, so on the y-axis here, along the left side, we use Maria and Lori's breakdown there of sort of financial motivations and non-financial is what we call them, or social motivations. But then what we saw in the literature is like when you have investors with short horizons and investors with long horizons, we're seeing very different examples of activism, how these investors engage companies, what they do, and then the outcomes that are that result from that. And so we found this, there's of course other dimensions, but even just as like a broad stroke, to think about shareholder activists, this was really helpful for us in just positioning the literature and understanding shareholder activists. And so, it's pretty obvious when we look at like the top left and the bottom right of what we might expect, like what we call transactional owners who are short horizons, financially motivated, negative effects on social and environmental outcomes, increases in stock prices if you're looking at event studies, and then sustainable investments. This is like long-term SRI pension-oriented pensions that have an social environmental orientation to them. But what's harder is sort of populating these other corners. That's what became really interesting for us, is like, okay, well, when you have long-term financial owners, like what's that leading to? Or when you have short-term E&S oriented owners, what's that leading to? And so to give you an example of this, in a paper in Org Science that was just published this past week, actually, we look at the effects of common owners on corporate social responsibility. And so common owners, we're not just looking at SRI investors, we're looking at just big common owners that basically what a common owner is, you own multiple firms in the same industry. That's how we define them. And when we got looking at common owners, they're forced to have long horizons because they basically own, these are index investors, they own big chunks of big industries in multiple firms, and they're sort of stuck there. And there's research there's a couple law papers that show like, are common owners, they ask the question, are common owners going to become activists? Because they're forced to hold the index and they're forced to hold these firms. And so they have to sort of begin to engage in activism to enact the type of change they want that's going to maximize their own returns versus just sitting back. And so we look at these common owners and we basically theorize that they have this systematic risk problem. That if you own multiple firms in an industry, when one company does something bad, that spills over onto other companies. Well, if you're a common owner in that industry, you sort of doubly or triply lose versus an investor that just holds a single firm. So you can imagine like BP deep water, that spills over to the oil industry, there's more tighter regulations. Well, that hurts everyone, brings the industry down. And so what we say and argue in that this paper is that these are a form of durable investors, or like long-term financially motivated investors, but they still have these really positive effects on CSR activities of firms because they use that as a way to manage systematic risk. If they can get one company to do something good, like Pepsi, reducing its sugar that improves sort of stakeholders' ideas about the soft drinks or sort of soft drink fast food, not fast food, but soft drink snacks business, then that's going to spill over onto Coca-Cola sales, onto Dr. Pepper Snapple, and this benefits common owners. So that's sort of the angle we take in that paper, but just a useful way to think about shareholder activists in these different quadrants. Just watching my time moving along, I want to just quickly break down a typical process for shareholder activism. This is something that can be often confusing. I know some of you on the call, you know this. I know some maybe not so much. So I want to just quickly lay out this process, and then I'm going to lead into a different idea, a way to see shareholder activism. So these campaigns, by no means do they always unfold in this process. And this is like a highly nonlinear process, jumping around with different actors involved. And I'm going to come back to this. I'm saying this for a reason. But basically, you have along the top this target identification process that goes on where a shareholder acquires stock. They review this company like any engaged shareholder would. They look at other shareholders and what they're doing and their orientation, and then they may acquire more stock. But at some point, if they're not pleased with something with that, what they're going to do is sort of elevate the position from just being about sort of passive investment here to review to along the bottom right where they become an activist. So, and that typically happens in one of three ways. So they will contact management directly. So that's sort of the private behind the scenes that can start with a phone call, it can start with a meeting, or they might go immediately public. So they might go to the media, they might start a website, they might whatever. And then, or they may discuss with other shareholders, or they may write a white paper to get their investment thesis out there, whatever that is. But that sort of starts the whole activism process. And then from there, what they'll do is they'll try and negotiate a way forward. If they can't, then they may threaten a proxy contest, meaning they're going to put it for their issue for vote before other shareholders at the firm's annual shareholder meeting. Then they'll build a proxy platform, and then they'll continue. And this whole time, can they reach a settlement or not? As I showed on one of those first slides, is like for hedge funds, 90% of the board seats secured last year were through settlement, right? No one really wants to go down to proxy fight. Procter & Gamble a couple of years ago spent reportedly $60 million building their proxy platform. It can be a huge distraction. The CEOs, directors I've spoken to about this, it's like it is all consuming, on the jets all the time, meeting with all the shareholders, trying to build support. It's a tiring thing that if companies and activists can settle, then that is often seen as a win, but depending on how you're looking at it. And then, like I said, there's a lot of variance in this, but there's a lot of there's a temporality to this activism process that becomes really important. And then there's a lot of other actors, as you can imagine. I was interviewing a hedge fund principal, a guy who started his own hedge fund, an activist-oriented hedge fund last year, and he said he threatened a proxy contest on 3 different occasions. He's keep coming back, right? In that position with the firm, anytime the firm did something, the management did something he didn't like, threaten proxy contest. Okay, get his way. Okay, threaten proxy contest. So there's this temporality, these interdependencies, these nonlinearities. But that's the typical process of shareholder activism. So what I want to talk about is actually some recent work with Maria and Kevin Chua and Bit Hennis, where we're taking this idea of the activism process to the activism system, thinking about this from a systems lens. So who do shareholders engage? How do these campaigns unfold? And so understanding, sort of setting this up, is that activism firm dyads do not operate in a silo. I am guilty of this, right? We measure, I'm a quantitative scholar, we measure activist A, we measure firm Z, and then we look at outcome Q. And we're like, okay, well, activists here targeted and somehow they, this firm, and that led to this outcome. But, there's all this other, as I was just going through, all these other actors involved, all these different pieces. So the activist characteristics, their tactics matter for the outcomes we see. The target firm characteristics and their responses, how they engage, how stubborn is management, or how willing are they to bend to what the activist wants. There's other reactors involved, shareholders, the media, proxy advisors, and then a whole institutional context, right? Sometimes you see politicians speak out against activism. Like, all this stuff matters in these campaigns because they unfold over time. And so what we do in this paper is, this is sort of our basic setup. So you have step 1, target identification, an activist, as I was showing you in that other JOM paper, you have an activist type and then a target firm, and they match up. Here's the dyad. But then you have this engagement process that unfolds. You have other stakeholder reactions coming in, or reactors, and then you have the activism outcomes on the right side. And as I was saying, what's really important, I think, where we want to go with future research is to think about all the other aspects of these campaigns that go on. And I don't really have time to get into all of this as we do in the paper. But activists and firms can leverage different reactors, say. So they can go to other shareholders, and as activists do in that activism process, they will go and solicit support for other shareholders when they approach management to say, hey, we have this much voting support. We have these 7 shareholders that are backing us, so that they can quickly get what they want. We don't understand a lot about that, I would say, in our research. Or they can influence the media, or they can engage with regulators, use them to back a case. Maybe political ties matter here. But the point is that these interactions, these indirect effects matter. It's not just the engagement, the activist firm dyad that leads to an engagement that leads to an outcome. And then as well, the outcomes of the campaigns, I think, will affect the reactions of stakeholders in the future, right? So just as another example, when engine number 1 targets Exxon on a campaign that is supposed to be, to change the environmental social impact of this company, well, I think what matters in that campaign will impact how shareholders back engine number 1 in a future campaign. It makes sense, right? And we need to account for that. But if engine number 1 just does all the same traditional playbook stuff, it jacks up dividends, takes out the cash of the firm's balance sheet just to repurchase shares and line shareholders' pockets, well, that's going to lead to different outcomes in the future. So there's all this dynamism and complexity that matters, thinking of the shareholder system. So the 2 big points there that I just want to emphasize is there's a significant need for shareholder activism models to account for the various reactors, the bottom box there, how campaigns unfold, and then an equally big need to understand how these campaigns unfold over time, the non-linearities, the dynamics, how future campaigns are affected by prior campaigns, and all these aspects that aren't so, there's some exceptions, but aren't always so easily captured or readily captured in some of the research. So to give you a case study of that from like a quantitative perspective, so I acknowledge that there's that qualitative research here more about like the temporality of activism. But from a quantitative perspective, how do reactors matter? When we're looking at the literature, there's only two papers that look at the effects of media and how they affect activism campaigns. So in this paper with Stephanie Song and Yifan Wei, what we're looking at is like when shareholders have this unrest through however we measure it, voting, proposals, resolutions, when they're engaging managers on social environmental issues, do they actually have impact on the firm outcomes on the ENS, right? There's a lot of debate. Some papers show yes, some papers show no. Some papers show it depends on the activist type. What we argue and find support for in here is that the media is going to play a big role, whether they cover that and how they cover that unrest and that issue. So this reactor really matters. The regulator, whether they pull that aside and say something about that campaign, that's going to have this positive effect. So it's like we're kind of indifferent on this main effect. It's a wash sometimes, like depending on what shareholders do, it could go one way or another without digging down into the shareholder type. But really what matters, what we want to draw attention to here from a system perspective is that the reactors all of a sudden really matter. The media matters, the regulators matter, others will matter. Proxy advisors, of course, will matter. But that's just an example of sort of this systems approach. So the point there is thinking about shareholder activism from the activist firm dyad to a process that is embedded in a system. So I'll come back to some of this as we get into future research. So, all right, I got two little chunks left here. So what I want to talk about is drivers of activism, some of them, some examples, and then I want to talk about some of the outcomes of activism. Then I want to talk about trends and moving forward. So it's no surprise that there's a lot of literature on activists engaging firms on problems, right? We see activism as a mechanism to resolve what a shareholder sees as a problem. Shareholder wants the firm to be managed a certain way, they engage in activism, and it's that way or that problem that drives their targeting. So things like governance issues, strategic issues, transactional issues, financial restructuring, business issues, things like low, CSR, operational inefficiency, these are typically seen as the problems, the main drivers of shareholder activism. And this sort of aligns with the literature, right? And depending on if you're finance, you may look more at, high cash on the balance sheet or, low dividends or low stock prices, and that's driving financially oriented activism. Management scholars looking at different effects of CSR, different director compositions, how that affects activism. There's lots of drivers, lots of research out on the drivers. One example is that we found interesting a couple of years ago is, and this came out of an engagement with Danone, Emmanuel Faber, when he was actually the head of Danone. He was targeted by Corvex in 2017. Corvex is a major hedge fund in the US that targeted that company. And then 2 years later, we know Emmanuel Faber got targeted again by two hedge funds and lost his position as CEO of that company. But basically through my engagements with Emmanuel, he was seeing how shareholders saw CSR as a problem. They didn't get it, how it was creating value or important for Danone. And so through that led us to this paper of how hedge fund activists see CSR as a potential problem for a company. That it's not focused so much on share price maximization, but on stakeholder orientation. And it's not so much focused on the short term, but more on the long term, and how this can create problems in the minds of hedge fund activists for companies. And so what we found in that company, in that paper, the main finding here is that the probability of targeting, so this is probability of hedge fund activism, and this is measured using KLD scores, so sort of the whole range of the KLD index. 21 is pretty rare, but as your CSR score goes up, your probability of targeting goes up from roughly 2.5% for a company to being targeted at about odds about 1 in 5. So not a good story for companies engaging in CSR. Right? Where this led me, as I was doing some of the interviews with hedge fund managers, is a shift from seeing activism as purely this problem-driven approach to an opportunity-driven approach. And so when I looked at the finance literature, when we look at hedge fund activism papers, there's a couple papers showing like hedge funds tend to target companies with more institutional ownership. And that's kind of an interesting finding, because what it's saying is that, and when you, through the interviews, this became really clear, is when you have more institutional ownership and bigger ownership, like bigger chunks of shares held by fewer shareholders, it becomes easier as a hedge fund or as an activist investor to convince those few investors to back you before engaging in a highly public campaign. So in the US, there's this rule with the SEC, rule of 7, where an investor is allowed to go out and solicit bids from 7 different investors before publicly engaging in activism. So they can already have a lot of support. And this is really important for what I'm about to show you on the next slide, because it gives activists a head start, at least in ownership activism, because you've already got all this support and you say, okay, well, company X, if you don't do what we want, we have these shareholders backing us with BlackRock, Vanguard, State Street, whoever, Fidelity. And, you know, this is going to happen regardless, because if it goes to proxy, they're going to support us. But what this means to me is that it's not just about problems anymore, it's about opportunities for activists. Do they see opportunities to profit in company rather than just purely a problem? You can think, you know, as they're doing their screens for companies, that it's not just about problems, but it's about opportunities. And so what we found in this paper with Emilio Marti and Wei Shi is that board diversity from hedge fund activists is actually seen as an opportunity. This is quite controversial, I think, but through our sort of approach in probing this logic that I'm going down to, is what we see. There's this Bebchuk paper, Bebchuk et al. In Finance, Dancing with Activists, and they show that prior to the annual shareholder meetings, which most of them happen in May, in the US at least, and then April, and then March, basically early spring, late winter, is that this is when most of the campaigns happen, just months before these annual shareholder meetings. And Marty Lipton, famous corporate defense lawyer, talks about these activist lightning strikes, that activists go in and they go right before the shareholder meeting, because that puts this immense pressure on management. Imagine you're the CEO, an activist comes to you and says, hey, we've already got 40% of your voting support behind us. It's 2 months to the annual shareholder meeting, do what we say, or, you know, this thing's going to vote, right? It's a pretty, you're done. You're sort of sunk in the water as the company. And so what we do is we draw on that and think about this activism process and timing, and you look at board diversity, and board diversity slows down board decision-making. This is clear in the literature. And it can also hamper unity. That's a little more maybe controversial, but it's clear it slows down board decision-making. Then there's some papers showing the unity effects. And I think that's a good thing, right? In that we don't, when diverse populations, it's the benefit of diversity, right? We see the world differently. We can engage, we can bring different values, opinions, beliefs, and we can make better decisions. So there's like research showing board diversity leads to more innovation. And that is great in normal circumstances. Where hedge fund activists come in is that creates an opportunity. If you're a board, anything that slows down firm decision-making, if you're going to launch an activist lightning strike right before an annual shareholder meeting, anything that slows down that firm's response speed, well, that's an opportunity. And so what we find in this paper that I think is really important and interesting as we think about the governance mechanisms, you know, there's a question about how do firms defend themselves if this is the world they operate in? Well, we find that activist hedge funds, they target firms with more demographically diverse boards. Well, that's just exploiting sort of this opportunity window. And that becomes really important for designing companies that how do you, or you know, regulations, how do you guard against these? And so some of the implications we try and bring out of that paper is that, you know, how do we get away from activist lightning strikes? How do we have cooling off periods to sort of avoid some of these adverse consequences that can come when profits are front and center? Okay. So some of the other drivers, just really quickly, and then I'll get into outcomes. Firm size is no longer a constraint to ownership activism. You know, here's some of the largest activist targets in the prior year. These are billions, market cap in billions of dollars, right? So Exxon, $250 billion market cap company. You know, it used to be that ownership activism was driven by, you know, mostly in small companies. That's no longer the case. Another driver I want to bring your attention to is can be done with the case study of Reed Hastings. So Reed is the co-founder CEO of Netflix. Tremendous shareholder returns over the prior decade. If we go back even further, this gets into like 5 figures. I think it's like 20,000 or something %. Just a ridiculous shareholder returns for Netflix. We know this, right? Disruptive blockbuster and all that, recreated streaming online. But when you look at Netflix, they still attracted all these demands from big time activist shareholders around sort of governance and finances. This wasn't around environmental, social demands, because that would maybe make more sense. And from big activists like CalSTRS, Icon, Carl Icahn's fund, trying to target Netflix on financial and governance-based issues. And right away, I think these problems are really fascinating. These case studies are super fascinating as a scholar, because it's like, well, why? I get if it's like environmental, social demands, but why would you target a company creating those kinds of shareholder returns on financial issues? And what we did is we analyzed Hastings' speech. So this is a paper with Wei Shi, and we looked at when we look at CEOs and how they speak, okay, if it's not about shareholder returns, if it's not about environmental issues like those problems and opportunities, when we look at the speech patterns, can that help us predict which types of companies are targeted? If we think about activism from an opportunity perspective lens. And what Hastings' speech shows is that he's in the very top percentile for using agentic-based language. And we know agentic-based language, those types of words, when you look at those dictionaries, are control-oriented words and independence-oriented words. So what this can suggest to shareholders is that CEOs that speak a lot about control, independent, that type of leadership, that can create concern that they're shut off from shareholder feedback, right? Shareholders like to think, especially hedge funds, you're the owner of the company. You have the say in how this company is managed. When a CEO gets up there and says, out there, I'm detached from shareholders, this is my company, that can create these sort of agency-based concerns. And so what we find is that agentic speaking CEOs, they increase activism, especially control-based activism demands from shareholders. And it's especially so these are amplified when those CEOs allow more spending on corporate and stakeholder-oriented investments. So there's bigger concern among shareholder activists of agentic speaking CEOs who have an orientation towards control and independence if they're spending a lot of shareholder or firm resources on these initiatives. Because if those are meant for empire building or reasons that aren't maximizing share value, then that's a concern. So anyways, what are the main takeaways here? Moving into the final section is that there are many problems that drive activism, but problems aren't the only thing. Opportunities matter, language matters, companies need to be aware of this. Scholars, I think we need to be aware of this as we're looking at, when is activism good? When is it bad? And then how do we design companies that, want to protect certain companies or not? What's the governance structures that need to be put in place? I think this is really important from in the topic of shareholder activism. Okay, so we got a few minutes left. So I'm just going to quickly fly through outcomes because I actually want to talk about trends and end on 40 minutes because I want to hear your questions. What do shareholders change? Well, they target on problems, they sure well change those problems, right? Governance, strategic, all those same things. But this depends heavily on the activists. This is where I want to come back to activist heterogeneity and where it matters. In this paper, we look just with between activist types. So you remember in that, one of those first slides I showed you, there's different classes of shareholder activists. And so 2 of those were corporate shareholder activists. These are firms targeting other firms with like Schedule 13D filing, so an intent to influence those companies by acquiring shares. And then we have hedge fund activists. And in this paper, what we show is that corporate shareholder activists, they basically increase the target company's long-term strategic action. So things like R&D and strategic alliances and big strategic moves, and they decrease short-term, they get away from short-term actions. And hedge fund activists, they actually do the exact opposite. That even though these are both types considered shareholder activists, hedge fund activists, they actually decrease those long-term activities and they increase short-term tactical actions like new product introductions, price changes, marketing campaigns, those kinds of things. And that's where they're going to try and create their value. So very different temporality between activist types, between share classes. And then even within activist types, this is where this becomes even more important. So if you think of just those classes, I was telling you, well, the amount of ownership may matter, or whatever the characteristic, is if we look within a specific class of shareholder, well, you can see different outcomes. So in this paper with Rudy Duran, we find that firms targeted by hedge fund activists, well, their CSR, CSP, corporate social performance, it gets suppressed. So where non-targeted companies, they continually do more CSR over the sample observation window, these targeted companies just kind of flatline by roughly a 25% gap after 5 years. But in the article I wrote about the engine number 1 campaign targeting Exxon on the conversation, what this shows is, or doesn't show, but questions, is are there exceptions to this? So we look at this, right? The finding of this is hedge funds, always bad, always down with CSR. But engine number 1 sort of turned this on its head a little bit for me as a possible exception. I don't know. I think the jury's still out. I'm still skeptical. We'll see what happens. But are there exceptions even within shareholder classes of what the investors look for? So as I said at the beginning, we're seeing a blurring of social-oriented activism and financially driven activism. Well, engine number 1 is a case of this. It took 3 seats on Exxon's board to sort of shift the whole strategy, that Exxon into a more renewable energy company. We'll see if that transition happens, but there's exceptions within each shareholder class. So the lesson here is you must be careful about heterogeneity among the shareholder activists. And coming back to that Journal of Management paper, just really quickly, that's what we try and bring out in that whole paper. We kind of talk about this 3C model, thinking about shareholder activist class, shareholder activist characteristic, and shareholder activist channel of influence. Okay, and that's going to really have different impacts on stakeholders. That's the insight we draw from that paper. Okay, so in the last couple minutes, let's just summarize this. I want to talk about 4 key trends or predictions looking forward and what these create opportunities for as scholars, and then have a Q&A. So 4 things I want to mention is that ESG activists, they'll continue asserting themselves. We're going to see more ESG activism. As scholars, we need to understand this. This is the engine number 1. Increase in proxy contests and minority activist director positions. I will talk about that. We're going to see probably more privatization, I think, and private equity style activism. I will talk about with that. And then I know some people on the call who are interested in retail and individual retail synonymous investor activism. So let's talk about that briefly. So more activists are showing interest in ESG. We saw a couple of years ago, depending on how you measure it, but sustainable investment or ESG-oriented investment surpassed $1 trillion for the first time. Basically, whatever numbers we use, there's more investment dollars in ESG-oriented funds. And what that automatically means is in that shareholder activism process, because activists depend on the support of other shareholders to get what they want, if more other shareholders are caring about ESG, well, you very well better care about ESG as the activist. And so what we're seeing is these more traditional financial styles of activism that have historically been oriented towards just finances, like hedge fund activism, well, they're starting to bring in these ESG implications. So we see the rise of these ESG activist funds like Impactive Capital, engine number 1, as I've talked about, Jeff Ubben starting Inclusive Capital Partners. These are hedge funds that are using hedge fund style activism for ESG-oriented aims to basically boost company stock prices, but with an ESG element to them. So we really need to understand this. Engine number 1, just last week, launched sort of its second, or at least in talks with Coca-Cola after coming out of Exxon, where they're engaging Coca-Cola on new recycling initiatives. I mean, we want to understand this stuff as scholars. Can these hedge funds create pro-CSR, pro-ESG outcomes? We're going to see more proxy contests, I think, and we want to understand this as scholars, but a rise of activist directors on boards, but with fewer fully clean slates. So what I mean by that is not whole boards being overturned anymore by activists. The first of that was done in 2013 at Darden Restaurants by Starboard. But what we're going to start to see, I think, is more of these minority director positions on boards. And this is because in the US, at least, the universal proxy card came into effect on August 31st, where shareholders can now vote basically for a mix and match of the activist directors that are sponsored in these campaigns and the management directors. And so this allows a passive shareholder to no longer just fully side with an activist, which can be a hard thing to do, or fully side with a firm, but to mix and match. And so I think we want to understand these campaigns because these directors can have long-term implications for firms, right? They can sit on boards for multiple years. I've interviewed a lot of these directors over the years. We don't have a ton of research on showing like the impact of activist directors. It gives direct representation of the activists on the company board. Well, what does that do to companies over time and their orientation? I think another opportunity is to look at this private equity style activism. This is more on the financial engineering side, but historically we've had private equity as like offering friendly buyouts on a company's timeline. Hedge fund activism as like an acquisition without consent to force a change. What we're seeing now is more of these hedge fund activists have their own private equity arm to basically allow them to be the push. So they're taking a position with the hedge fund to push for the sale of the company, and then they can take a position as the buyer and sort of double end that deal and buy the shares. This can potentially screw other shareholders because you have a huge conflict of interest within that fund to sort of get a lower stock price if you're buying it yourself, right? We need to understand that. We need to understand how these two worlds, private equity and hedge fund activism, come together to create sort of different effects for other stakeholders, other shareholders. And then finally, I think what we're going to see, this is one of the most interesting things, I think, for me in this space, but retail investor activism. And that's being bolstered by fintech. It's being bolstered by, there's a couple working papers out there, but being bolstered, which some of you may be highly knowledgeable of this case already, but I want to quickly run through it and then end about what happened at GameStop and Reddit. And I find no better way to explain what happened at GameStop than I think through these 4 charts. So just track with me here. I want to give you this case and then why this matters. So over the past 10 or so years, there's this forum on Reddit called Wall Street Bets. And what we've seen is like growth in Wall Street Bets, number of participants increased tremendously over the past decade or so. So more individual retail investors going online. And what they basically do there is they discuss stock prices. So there's a forum you can click, you can see here, like the trend of this, it's just based on like Meta's stock price and all the comments. And you can basically discuss company stock prices. Okay, so there's this trend going up in like these online digital platforms to discuss stock prices, like uniting people. And what was happening at the same time is like institutional investors, they were betting against GameStop. And then COVID hit. And it was a crappy time to be a retailer. GameStop had a lot of short selling, a lot of big hedge funds saying, this stock is going to tank and betting on that tanking. And you can imagine a lot of people probably early on who were on Wall Street Bets maybe cared about video games, maybe not. For some reason, these two things collided and mattered. And so what happened in that third in the bottom left there is that users on that Wall Street Bets forum, they began to rally around a few investors that saw value in GameStop. So there were a couple major investors that said, okay, hey, no, there's value here. Let's buy into this stock. And that just dominated into this like retail investors pouring into GameStop stock. And what we saw is like one of the most tremendous rises in stock prices over a very short window. What became really interesting is as those retail investors started buying GameStop stock and shot the price higher, the hedge funds were forced to cover their short positions, meaning they had to buy stock and get out of their short position. And as that demand surged, well, so did the stock price, and it created a lot of issues for hedge funds. So it's like seen as this huge, tremendous win of retail, of investors that, like saving the day and overturning these big Goliath hedge funds. And what Bill Ackman, one of the most famous hedge fund managers, said, speaking about this case, it says it does show you the power of retail to move stock prices. The biggest investor in the world is retail. It's not the institutions, like not the hedge funds. And I end with this because I think it's important for all of us on this call right now. He is right. We think, institutional ownership is off the charts, 70, 80%, depending on which country you're in. But institutions, their dollars come from retail investors. You as an individual, me as an individual, where we have our pension, where we put our savings, well, that is owned by some institution down the road, right? And what they're doing, well, that can have influence. But ultimately, those are my dollars. And so I'm the biggest investor, right? The retail, all of us individually and collectively. And GameStop was amazing in showing the power of that when retail moves together, right? So anyways, there's this empowerment that's coming with fintech, with these social media platforms, I think is really interesting and can totally shape the future of finance and of activism. So new realities for companies is activism's here to stay, but it's totally changing. It's evolving in different ways. Some activists can have negative effects. Some can have very positive effects. There's a need for scholars to identify different types of activism, the likely effects, and how value is allocated between stakeholders and shareholders in this world where shareholder capitalism and stakeholder capitalism is coming together. So with that, I just want to thank you. Looking forward to your questions. And yeah, thanks, Maria.
Thank you so much, Mark, for this very, very insightful presentation. This event is sponsored by our Ethics Center. So, of course, I have to ask you the first question that has ethics in it. Do shareholders have ethical responsibilities to the firms they target? You mentioned a huge heterogeneity, that some shareholders are there for the long term. I think you call them stewardship shareholders, and you talked about more transient investors. So what is your take on that?
I mean, this is such a individual-based question, right? Do they have ethical responsibilities? I sure would like to say yes, that they do. I think there's a lot of investors that would say no, they don't, right? That they have a fiduciary responsibility to their investors to maximize their share price, and that's their legal responsibility. And so their way of doing that is actually maybe targeting companies that may not be best for those companies, because actually their responsibilities to their own investors that are investing in that hedge fund or that mutual fund or that pension fund. But yeah, I mean, we'd like to think they do, but we know legally they don't.
Yeah, no, because you mentioned
it's the reality, right? Because otherwise we wouldn't see these effects where if they did have that ethical responsibility, we wouldn't see some of those things that I was just showing you in the research.
Yes, as you mentioned, that they target companies with more corporate social responsibility, more diverse boards, and we know that they also target more companies with female CEOs, right?
Yeah, and that's what makes it really important from a researcher perspective, right? Because if they had the ethical responsibility, well, then we wouldn't see some of the problems we did, and there'd be no point in doing this stuff, right? It would take care of itself, but it doesn't. So we have to think about that carefully.
Mm-hmm. Another question that came through on Zoom from Cynthia Clark is going back to your activism process and your ideas about systems. What are your thoughts about ideological pressure over time versus undervaluation?
What do we think about ideological pressure over time versus undervaluation? I mean, that's changing, right? As I was getting at in those last slides, is that this is becoming more about ideology and less just about share price, undervaluation. So there's 20, 30 years of hedge fund studies showing like firms with lower stock prices, they always get targeted. But now what we're seeing is like, well, that's not, and as I was showing there, is like, that's not the only driver. And so we're starting to see sort of more of this ideologically driven activism, and that's actually having an effect, and that's actually can lead to big success on the activist side as engine number one, right? You could argue that was ideologically driven around the social environmental piece, and that led to, even though they had a financial thesis for that, that led to, engine number one had 0.02% of Exxon's stock price and appointed 3 directors, right, from that side. So obviously that's becoming more important. It's not just about the share price.
Do you think, I mean, just like a follow-up on what you said about Engine 1, do you think that we do have quite a few research on coalitions of socially responsible investors like Interfaith, the Center for Corporate Responsibility, and others? But do you think that coalitions and networks of hedge fund activists and other activists like so-called wolfpack activism or hedge fund activist relationships with other institutional relations, with other institutional investors would become more important to study in the future?
I mean, I think for sure, right? And especially, depending on how they partner with one another, but also especially, I was getting there at the end, like the private equity arms, it's not just within like a hedge fund and a private equity and their sort of one private equity arm that they can target a company. But what we're seeing, and there's sort of, I've spoken to some practitioners about this, is like these unwritten agreements of hedge fund X pushes for the sale of the company, and then they agree they're going to pick that other hedge fund or with the private equity arm as the buyer, but they're going to get them the best deal as long as they pat them on the back and it goes back, right? So like these networks of activists become really important and really complicated to identify, but really important to study. So I think, yeah, there's research showing like hedge fund activists are more powerful when they're in a wolf pack. There's lots of research showing like, collectives of NGOs that take stock price and a movement together, that's more impactful. So yeah, we need to continue to go down that road.
There were quite a number of questions that were talking about the trends in shareholder activism and how it would evolve. And I know you talked a lot about it in the presentation. I think the question on everybody's mind is to what extent the push for short-term financial performance kind of fuels also demands for ESG shareholder resolutions and shareholder activism. For example, one of the questions is, given that there is strong focus on ESG issues and subsequently the rise of ESG activism, do you think the gap between hedge fund activists and shareholder resolution activists is now smaller than ever?
I think it's shrinking. I mean, it's forcing those two things to come together, right? That as ESG becomes more of a financial issue, then you can't just make a stock price case. It's the ESG tied into stock prices. And so, yeah, we're seeing, where shareholder resolutions, if we think about a lot of those as social governance, environmental issues, well, we're starting to see hedge funds make more of those cases. So yes, that's bringing those two closer together just naturally.
Thank you. Another question that we have is, again, between this tension between short-term and long-term profitability. And the question is, in the event that long-term orientation requires the company to forego short-term profits, how can a publicly traded company protect its long-term strategy against opportunistic shareholders?
This is a really good question, a really tricky one. I mean, it takes me back to 2017 conversations with Emmanuel Faber, who was on this road. He was just back from meeting shareholders in Miami, and he was talking about how, how they didn't really get the CSR approach that he was trying to take with Danone and why purpose mattered. And it wasn't, creating enough value in the short term. And that's where these studies on hedge funds actually came out of, from the conversations, like I said, with him. And it's a real predicament that CEOs, directors, management teams find themselves in. So what do I say there? I mean, what's sort of some of the solutions? I don't think it's just the problem with governance-based mechanisms. So I mean things like proxy pill defense or splitting up your board, making it harder for shareholders to have influence. The problem with that is it ticks off all shareholders. It can. So so then that allows the activists to get more support because it's well, this company is just seeking its own control. And so that's not such an easy fix, even though some people might think it is. The number one thing, and this goes back to my days in investor relations, is to keep a close pulse on shareholders. Hedge funds catch companies off guard, but they have so much more success when those companies don't know where their shareholders stand. So that's where, you might see it as distracting and a waste of CEOs' time to go around to shareholders, but shareholders ultimately have the vote in the world we live in and make those decisions. So the best defense against that is, especially as you're going into more long-term, big strategic initiatives, which can hurt in the short term if there's big investment and you haven't seen those returns yet, is to make sure your major shareholders are on board. That's the best defense. So.
And Mark, one of the questions, and I know that you said that you found different results in terms of hedge fund activism versus corporate shareholder activism. So one of the questions is whether those corporate investors, are they large block holders? Are they not large block holders? And what is driving their longer term orientation?
Yeah, so this is, these are stakes where these were 13D filings. So in the US, you have to take over 5% ownership to file a Schedule 13D. So they were block positions, but they weren't majority ownership or anything. What we draw on in that paper is the corporate venture capital literature. What these corporate investors are doing is sort of using these target companies as testing grounds to sort of take a minority stake, develop ideas, innovations, and sort of maybe eventually acquire those companies, but not for the meantime, they're just a smaller block holder. So that's what's going on there versus hedge funds. I mean, I think it's clear on average, these cases is like, well, those huge long-term, you know, as a hedge fund, a big experimental project with a new innovation really isn't your role, right? That's not going to maximize your return. So it's getting away from that type of stuff and just outputting more products faster with prices that are going to maximize share prices over sort of a defined window. So that's why you're seeing those different effects.
So this with the 13G, these are shareholders that are saying that they're not trying to actively be involved. No, they are trying.
Yes, and David. So like they are trying to influence. The 13G is in like Goliath. That's the passive over 5% ownership. So they were trying to influence. Yeah.
And with 13D filings, we know anything that's above 5%, it's filed with the SEC. With other activist campaigns, often there's some media attention. So, but what is your take on private behind the scenes, so to speak, shareholder activism, where other shareholders may not be aware? And I believe BlackRock themselves said in one of their letters one year that, you know, they talk to a lot of companies, but shareholders may not be aware if their engagement is successful. Yeah,
I mean, it can create other conflicts, but I mean, I think discussion always needs to happen behind the scenes. I think the concerning cases is where it just blows up public, like all the way, and these two sides never came together. So I think that can be constructive. And what we're seeing actually is like more hedge funds trying to disassociate themselves, even with the label activism, in like anything confrontational, and they're going more towards like these dialogue-based approaches. Because it's lower cost and there can be, you know, benefits of that. But, you know, hopefully the orientation is that like you don't want these big public proxy fights to happen, right? I don't want to ever come across as like fully anti-activist on this side, on the financial side, because I think sometimes these things are necessary. CEOs, as we know, have decades of agency theory showing like empire building. CEOs, management teams can get off course. And so that's where I think the dialogue behind the scenes can really help. Like, hey, do you know you're getting off course here and the shareholders aren't fully on board? Let's talk about that, get company back on track. I think that's where we see benefits from behind the scenes activism.
And normally, right, I mean, historically, we have seen shareholder activism as helping improve corporate governance, helping improve environmental, social outcomes, and so on. But you mentioned agency theory, right? I mean, what is to prevent the chief executive officer siding with an activist behind the scenes for their own interest? And should we have some disclosure so that other shareholders at least are aware of the demands that shareholders pose to the companies, especially given the heterogeneity of demands?
Yeah, I mean, I think if there's things that are agreed upon that lead to, I wasn't sure that's where you're going with that question, but if there's things that are agreed upon that shareholder wants, then yeah, this can create big conflicts of interest. So I think disclosure does help, especially like where I was going with the director representation. We have a paper right now, like looking at when activist hedge funds get directors on boards and how that affects the lives of employees. Well, employees don't have representation. And a lot of things, like we start looking at these campaigns, you know, there's a scary reality that the people at the top can come out on top on both sides of the fence on the activist firm dyad because they can strike an agreement, right? It's like, okay, well, we'll do those buybacks for you if you do this for my compensation. Right? Like there's agreements that can happen. And where that gets really scary is like when we don't have those fully disclosed, like, well, how do the employees that don't have representation of the communities? So yeah, I mean, more disclosure is typically better with all of this. We need to understand what's going on behind these scenes in these high stakes cases. So.
And you mentioned employees, and we know in some European companies that may be different. So one of the questions here is that based on your findings, does the explosion of ESG activism contribute to convergence of corporate governance codes related to ESG risks?
What was the last part? That contribute to convergence?
We're looking at corporate governance codes related to the ESG risks. Do you think that we'll see some convergence? We certainly hear some voices how in the US maybe employee activism could act as some sort of governance mechanisms, right? Especially if the company is going in the wrong direction in terms of ESG risks. But what is your take in terms of, do you think we'll see more of a convergence in terms of those ESG risks, how they are incorporated in corporate governance codes globally?
Yeah, I mean, I think so. I mean, globally, there's, and it, again, varies by country, but there's more attention overall to these ESG issues. And as more investors care about that, well, that's tied to the campaign. So yeah, I mean, I think that's sort of a natural outcome of what we'll probably see there.
And we have a couple of questions in the Q&A feature, which I think are somewhat related. One is related to the institutional ownership, right? And I guess they're asking whether the composition, right? I mean, if you have more long-term oriented institutional ownership, would that prevent shorter-term hedge fund oriented activism? And do transient short-term investors necessarily cause short-termism or reductions in long-term investment? And I guess the question there is, we know like creative distraction, right? I mean,
yeah.
And some people will talk about the $6 trillion question, right? Companies in the US have spent $6 trillion on stock buybacks. Is that good for the overall for the economy with all those funds going to more productive use? But essentially, the question is arguing that transient investors shouldn't necessarily have to reduce long-term investments to make a quick buck in the near term.
I mean, this is a big tension. This actually what drew me in early on to this coming out of investor relations is like this temporal tension between short and long term from an investment decision. And this is coming out of like Brian Bushy's paper in '98 showing like investor myopia and R&D. But yeah, what we see like in the research overall, more long-term institutional investors, and that's kind of like the common ownership paper in CSR I showed you there, is like that helps give managers discretion towards more long-term decision-making. Because, well, if your investment horizon is 10 years, you're discounting future cash flows at a different rate than an investor with 2-week or 2-year investment horizon. And so all of a sudden, just by rational sort of economic models of like how you value a company, they change totally depending on your investment horizon. That changes the types of decisions you make. It has to be that way, right? It's all about your investment horizon. I mean, and Alan Brow's got a paper in 2008 showing like a hedge fund, the average holding period for an activist hedge fund is 13 months. The longest I had one hedge fund principal I was talking to, I think he found like 5 or 6 years, but investing in tiny, small companies, highly developable. A lot of the time it's like just months. And so, yeah, it's like, this is a really real issue, right? What's the investment horizons of investors, and how do you reward investors through like loyalty rights or voting? There's all these things, the regulators are considering and have tried to make shareholders have longer horizons, because that can help spur some of the decisions that are beneficial for the economy and society that don't happen with a company that's dominated by short-term investors. So I think that's really, spot on that question.
Thank you so much, Mark. And thanks everybody for coming today. And thanks again, Mark, for this very insightful and very, very interesting presentation and discussion. In interest of everybody's time, we are literally at the last minute. So I'm going to reiterate my thanks for you for sharing your research with us and, taking from your busy schedule in the middle of the semester to come and be here today. Thank you so much.
Thank you, Maria. Thanks to the center, and thanks everyone for attending today. Appreciate it.
Thank you.